Okay, right. Well, everybody, since we've gone around the world and seen where you're all from, welcome to the first of our 2022 webinar series for Aussie Expats Coming Home. I'm so excited that you're all here, and for everybody who watches it on the recording, I'm excited that you're watching it on the recording too. This has taken a long time to organise, and it's been a huge amount of work, and I always say to people that repatriation is like a pie. You know, you can't just do, you know, 1/4 of the pie. You actually have to get all the pieces together so that everything goes really smoothly when you're moving home. So hopefully today, Odin Mortgage and Martin and his team will be one piece of the pie for you, and we will move on and let you know what's going to happen today. So we've got another slide there, Martin. Okay, so I'm not going to spend a lot of time reading through this. Martin is an expert in this. We've gone through the webinar, and I think it sounds really, really interesting. Areas I had no idea about. The area that I'm really, really interested in is finding out whether you should buy now while you're overseas or when you get back. It's a question we really struggled with, and we sold our dream house in London. And I think if I'd had Martin on side back then, we probably wouldn't have done it. We might have been able to work things out a different way. So Martin, really looking forward to that. I'm sure everybody is. Next slide. Okay, well, this is just about me. For those of you that don't know me, hi, I'm LJ Ferrara. I started Aussie Expats Coming Home in 2018, initially as a Facebook group to help me figure out how to come home after 20 years away. I left Australia with a suitcase and a hot boyfriend, and I came back 20 years later with the same boyfriend that became the hubby, a teenager, a dog, and a 40-foot container. And it's been really hard. It has been hard, but you know, we've got a great group. So we'll talk about that a little bit later. My main goal with Aussie Expats Coming Home is I love meeting people, and I'm a problem solver. If you get on my group and you say, what do I do about this? I will find your solution. If not, I know who can help you with that solution. That's what I love to do. So that's a little bit about me, and a little bit about Aussie Expats Coming Home. Next slide. And now we've got Martin. Now Martin is an Aussie. He's from Sydney, Chatswood in Sydney. And he's been in Hong Kong as an expat. That's why we're just talking about the restaurants over there. His background is very much banking and mortgages. And he started Odin in 2020. The team that work and run Odin across Hong Kong and Singapore are all Aussie expats over there. So they are just like you, except that they know what to do in this situation that you're about to face. So they focus purely on Aussies that are overseas and purchasing or refinancing whilst they're still living overseas. If you come home, so like me, if I want to call up Martin and say, hey, can you help me? He's going to say, I'm not interested. You're not overseas anymore. So, and before we move on to Martin, I will also say that Martin is also single, and over to you.
All right, thanks, LJ. Great to share the stage with you. Yeah, so let's get started, everyone. I'll probably go straight into the Australian lending overview. So a little bit of boring history for those of you who aren't familiar. Okay, so with the rate hike yesterday, I thought it'd be a good color to go over some of the things that have happened in the past. So for example, in 2015, it was actually quite easy and relaxed for expats to get mortgages. There was no need for overseas residents. So if you've been overseas for a while, you probably didn't have to use a broker a few years ago. Until 2016 and 2017, when the regulations started to change. And this was a result of the boom in the prices in the Australian market. The major banks, CBA, Westpac, ANZ, etc., they exited overseas lending. Then they exited overseas lending. And then 2018 onwards, credit policies stabilized, but these varied from bank to bank. So it was really important to understand the differences between policies amongst the banks to get approved. And then fast forward to today, the sharp rate increases coupled with all the political uncertainty and economic uncertainty has really seen all of our expat clients try to get ahead of the rate rises and get their living conditions sorted. So some of the very, very savvy expats actually started reaching out to us last year and getting everything lined up. And I don't think it's too late to do that now. And we'll talk a little bit more about rate hikes. So how have the rates changed, right? So 6 months ago, in November 2021, the fixed rates for investments were sub 3%, probably low 2%. And that's what we were recommending to our clients. We're recommending, hey, everybody knows rate hikes are coming. You may as well fix them for 2 or 3 years now, and you can take advantage of that. And for the clients that listen to us, they are still on the 2% rates, right? But fast forward 6 months to June 2022, look at the fixed rates now. They're on 4%. They're on touching 5%, right? So fixed rates, that ship has sailed. For the past 6 months, fixed rate hikes were going up by about 1 hike per month. So now our recommendation is actually to get on the variable rate, right? So our advice now is to try to get ahead of the rate hikes if you want to purchase. That depends if you're an investor or a homeowner, but we would be recommending the variable rate now. And one of the benefits of a variable rate is you can also completely offset your account and your interest. Okay, so one of the questions that people have been asking me is that, should we wait for rate hikes to stabilize, or should we start purchasing now, right?
I was going to say, Martin, we had Kieran in Hong Kong who specifically asked that as well.
Yeah, right. So that question, I guess, right, is there's always two sides to the coin. The for side is that as rate hikes go up, property prices will technically come down, right? So you could wait it out and you could probably see what happens to prices. The against side is obviously that with interest rates going up, you can borrow a lot less, right? So that's kind of what this slide is also trying to explain. So maybe I'll go into this slide in a bit more detail for those who are interested in this question, right? So 2010 to 2021, rates coming down, that was a good thing, right? Prices went up, and the action to take with the benefit of hindsight, obviously, was to go ahead and get into the market. And we saw property prices really shoot up on a steep uptrend for the past 10 years. Now, whether that will continue or not with raising rates, that's a question mark that no one can really answer, right? So the textbook says prices should come down, but who really knows? Even the economists don't really know what's truly going to happen. If you ask the RBA 1 year ago, they said they won't change rates until 2024. So they're always changing their minds. No one can really predict prices. But the course of action to take for an investor versus someone who's purchasing a home is a little bit more obvious. And again, this is also my opinion. So let's go into what the differences are for an investor versus someone who's purchasing a home. Right? So for an investor, I would probably say proceed with caution. There will always be gems in the market. But for the investor, they are probably focused mainly on investment returns, right? So this is very dependent on the purchase price and the cost base that you buy the property at. So if you're an investor, don't FOMO into the market and buy at the top. Really consider whether or not now is the time to get in, because price is actually quite important to you as an investor. However, also be prepared for a scenario where the prices don't drop. Your holding cost actually goes up because mortgage rates have gone up, and your leverage comes down, which means the actual investment return may not be as good as you had hoped if you wait it out. So that's a point for investors. Now, for those purchasing a future home, that kind of scenario or that equation looks a little bit different, right? So let's call it now or maybe 6 months ago, the assessment rates are still quite low. you can still get 2 to 3% mortgages, meaning you could borrow around $900K for a $1.2 million purchase. It could be a home with a backyard, a pool for the kids. It could be your dream home, right? So you could do that 6 months ago and even now if you can get ahead of these rate hikes. But if you waited out and let's say you waited for 1 or even 2 years, and the assessment rates, which is the cash rate, the mortgage rate, goes up to 4 to 5%, actually what this means is you can borrow less, right? So you could then only borrow 600K, and assuming you only had 300K in savings, like the example above, you would now only be able to afford a 900K purchase. So this is actually more equity tied down for you as well. So the homeowners are probably more focused on future standard of living. Do you want that home in a nice neighborhood with a barbecue spot, with a pool, with a nice backyard? These considerations mean that you probably want to get ahead of these rate hikes, right? So yeah, get ahead of these rate hikes and buy that home that you actually want to live in, because it doesn't really matter, in my opinion, if the property falls, let's call it 50 to 100K, takes a little dip in the next 2 to 3 years and picks up again in the next 3 to 5 years, because you're living in this home, you're enjoying it, you're spending time there with your friends and family. It doesn't really matter to you if the mark-to-market value of your property falls in price. Whereas it's a little bit different for an investor that has a 3 to 5 year holding period. So that's a little bit of an in-depth answer to that question. So how to move forward? So some other frequently asked questions are, should we opt for a fixed or variable mortgage? Well, fixed rates give you certainty and peace of mind on actual repayments, whereas variable rates, although they're currently cheaper, you could be exposed to extreme rate hikes. So let's say instead of the 1 rate hike per month for the next 6 months, we have 1 rate hike per month for the next 18 months. You could then be very exposed to the variable rate increases. But bear in mind, you can fix that anytime, fix your mortgage at any time, assuming you want to do that. The market view is that the weighted average cost over the next 12 months favors a variable option. Next question would be, should we borrow to the max? Well, borrowing to the max is possible while the assessment rate is low, as I mentioned earlier. When the assessment rate goes up to 4 or 5%, you probably won't be able to borrow as much, but make sure you can handle the repayments if the rates really do rise, or lock in your rate. How much buffer to leave for hikes? So we calculated on a $1 million mortgage, a 1% rate hike probably equates to around $500 on a P&I repayment, and about $833 of an increase per month if you're on interest only. So to know how much buffer you should leave yourself or how much the repayments are, you can check out our calculator on our website. So what's still possible? 70% LVR is still possible. That's quite easy to get if you know which banks to go to. 80% LVR is a bit harder, and one bank will do 90% with LMI, but it's actually quite hard to get. 30-year loan terms are still possible. Interest-only options are still possible. Cashing out is still possible. And we can also do self-employed mortgages. A lot of people were asking about this one as well, I think.
Martin,
yep.
We've had quite a lot of questions about that, and one person, Sarah from UAE, she wanted to know specifically, can you talk a bit more about self-employed people about the requirements for self-employed people, and what other considerations for self-employed individuals there are?
Yep. So self-employed individuals are probably one of the hardest ones to do. If you rocked up at a big 4 bank and tried to apply for a mortgage, they most likely turn your way. It's actually quite hard to get self-employed people mortgages if you go to a traditional bank. So that's where we can come in and recommend you something called a non-bank lender. Non-bank lenders are fully licensed in Australia, so they are fully regulated. They're quite safe. The only negative or downside to using a non-bank lender is the fees are slightly more expensive. So what are the items you need to grab if you're self-employed? So you need 2 years of tax returns, positive financials to show that your company is actually profitable. You need a credit check in your own company. There's a little bit more paperwork, and generally, yeah, the rates and the fees are a little bit more expensive. But it's definitely possible. Yeah. Okay, moving on. So yeah, next section is why should you use an expat mortgage broker for those that are based overseas? So a lot of people ask me, can I get financing myself? Well, yeah, technically you could do this yourself, right? You can then research 30 banks yourself, manage the agents and solicitors yourself, fill in all the application forms yourself, collect the documents, go back and forth to the banks, find witnesses, execute contracts. You can do all that yourself, and you'll most likely get rejected, and then you're going to pull your own hair out by yourself, right? The alternative is to use an expat mortgage broker, right? We do the preliminary assessment for you before submitting anything to make sure the application works. We guide you through the entire process. We manage all the parties for you, and we do this all for free. So for those of you that do like to pull your own hair out, here's 3 tips for you. Research which banks will apply Australian tax rates versus local tax rates if you're in a low tax environment like Dubai, Singapore, Hong Kong. Research which banks will lend 80% versus which banks will lend only 70% if you want to maximize that leverage. And tip number 3, research which banks have policies that are suitable for your situation. So for example, some banks will only lend to people working at multinational companies. Some banks will take bonus, some banks won't. Some will do refinance and let you cash out, and some will not. So really, that's where our expertise comes in, because we understand all the policies across 40 different banks, and we can tailor make, I guess, an application that's suitable for you and submit it to the bank on your behalf. So why are those things important? So I'm not sure how many people are from Singapore, but Singapore and Hong Kong are usually a great one to give examples for. So for example, if you go to a regular bank, yeah, they first discount your income by 20%, apply Australian tax rates, minus your rent expense, minus your living expense, you can borrow about 250K at a regular bank like your ANZ, Westpac, Big Four, CBA. You go to an expat-friendly bank, they don't even apply a foreign income discount, some of them. They'll apply a local tax rate, 15% or 18% for Singapore. Rent expense, the same, 6K, living expense, the same. But the difference is a 4 times multiple in borrowing power. So borrowing 250K at a Big Four versus borrowing $1 million at a more regional bank as an expat, that makes a world of difference. All right, so next topic, how to avoid settlement headaches when buying property. And the answer is get a pre-approval, right? So if you don't take away anything from my presentation today, remember this, right? Get a pre-approval. You don't want to be caught out. So what are the benefits of getting a pre-approval? Well, pre-approvals confirm how much you can borrow. They also mitigate against any loss of deposit and a void of contract. It gives you negotiating power relative to other buyers without financing. And they're valid for about 3 to 6 months. So you can really focus on the property hunting. And last of all, they cost you nothing because the bank fees are only payable upon settlement. So just to clarify here, we do not charge a fee as a broker, but the banks actually will charge you a fee. So the bank fees are not payable until you actually find a property. So it costs you nothing but time. What does that timeline look like? So step 1, come to our website, submit a form, and we'll give you an assessment. Then upload your own documents to our portal, and then we'll prepare the application and submit it for you. And then next step is you get your loan pre-approved, and it will last 3 to 6 months. You can begin the property search. And then finally, once you find a property, you sign the contract, and then you can settle on the property. So let's go through a case study of what not to do, right? So let's say we have a terrible client. His name is called Martin. Martin's a terrible client. He finds a dream home and decides to make an offer without a pre-approval, right? He is assured by the selling agent and the local broker that the financing is easy to get. Just make a bid. We'll sort it out. She'll be right. That kind of mentality. But what actually ends up happening is Martin is an expat. So it was actually quite hard to get lending from one of the major banks. And Martin ultimately has to renege on his contract and loses this dream home to a buyer at a lower offer because this other person based in Australia already had a pre-approval and could move forward quite quickly. So what's a perfect purchase, or what's the perfect client? Let's call this perfect client LJ.
Thank you.
Yeah, so LJ starts her pre-approval in June this month. She gets an assessment that's relevant for her situation, gets ahead of the hikes to maximize her borrowing, and then she begins her search next month in July and August, and she gets a buyer's agent to help her out while she's overseas. She then leverages on her pre-approval and the buyer's agent's ability to negotiate and really read the seller to negotiate a 2.5% discount to the offer price. So sometimes people get scared of using advisors because they charge fees or whatnot. But actually, if your buyer's agent charges you a 2% fee and you manage to get him to negotiate a 2.5% discount, then actually you come out ahead and you have a lot of people helping you, right? So then fast forward to October, LJ's settlement is now handled by her broker, her buyer's agents, while she's overseas. Okay, next.
Martin, sorry,
Yep.
this is a little, may I just add this in? I know that you weren't expecting me, but
yeah, that's fine.
I just wanted to sort of give everybody a heads up as well. Like we did exactly what Martin said, but we were back here. So we got pre-approval from a local guy who was great. But what we should have done is we should have gone to Martin and prior and gotten the pre-approval, because then there wouldn't have been any surprises. And in our case, the surprise was we were given the pre-approval on the condition that my HEX debt, which I had forgotten about, was paid in full. And when we arrived back, within about a week, we bought a car, and we put a little bit on a loan because we want to keep most of our cash. And they said, well, that car has to be paid out in full, which obviously triggers earlier repayment fees as well. So if we'd actually gone to you prior, we would have come back with no surprises like that, because you would have found all of that out for us beforehand. Right?
Yeah, that's
exactly.
Completely right. So your situation, if it changes in Australia, you're going to have to do a brand new application. So come to us first, then we can kind of assess your situation and make sure it works.
And just don't be surprised at what they ask you to do before they give you the pre-approval once you're back here. So yeah, anyway, hope that helps.
Yeah, definitely a useful point. Okay, next slide. So the pros and cons of cashing out equity, right? You can unlock capital gains that have accrued on existing property. So if your property price has gone up, then you can take out some of that equity. You'll minimize the cash contribution from your current savings for the purchase. You can potentially restructure unfavorable mortgages that were on a high rate to now a lower rate. You can also get cashback incentives to cover the switching costs. But it would be remiss of me to not talk about the cons as well. So if you cash out, you're essentially taking on a larger loan. So there will be higher interest costs. There will be larger repayments. You could potentially be over leveraged, and usually the tenor is increased, right? So another case study, let's go through an example of how this would work. So let's say you already have a property. You bought this property in 2015, cost you about 600K, you borrowed 80%, and you had a 480K mortgage on it. Fast forward 7 years, the property has now appreciated to 800K. You've paid down 80K on the loan. So the LVR, or the mortgage, is now 50% of the value of your property. What you can do is you can top up the loan, or cash out, as they like to call it, 240K of equity, so that your mortgage is now back to 80% of the property value. So 80% of 800K, 640K. You got 240K of cash to help you with your next purchase. So what does that look like for a $1 million purchase? So on a $1 million purchase, assuming you get another 800K loan, you then have to pay 50K of stamp duty, but you now take away 240K of equity that you used from the property above. So the net cash that you need to pay for this new property is only $10,000. So although that sounds really good, this depends on a whole host of factors, like can your income actually service these two loans? Because that's quite a bit of borrowing. But if you have strong income and you're an expat, you may be able to do something like this. So I noticed there was a question about something related to this. Yeah, on UK.
There's a few that have come in as well about people who are in who have property in the UK. Yeah, Helena and Jeremy have also asked that, can they use the equity in the UK to buy in Australia?
Yeah, so I can go into a bit more detail towards the end, but just quickly now, you can definitely tap into your equity from the UK property, but that would require a UK mortgage broker or a UK bank to help you tap out that equity. And then once they give you that cash, you just hold that cash in your Citibank account or your Australian bank account. And then when you actually go to make the purchase in Australia, you can then use that same strategy that's on the screen right now to reduce the cash that you have to pay. Unfortunately, though, we at Odin Mortgage do not deal with UK mortgages, so we wouldn't be able to help you with the first half of that transaction, which is to take equity out of the UK property. But the strategy definitely works. One call out would be, if you have a property overseas, the Australian banks generally do not like it as much. So they actually put you at a little bit of a disadvantage, because if you had like a 800K mortgage in the UK, that would be the equivalent of a $1 million mortgage in Australia. So the banks don't like it as much, because if it's overseas, it's not on Australian land, they pretty much get a little bit cautious about what you're doing overseas. So generally speaking, they do not like that. And generally speaking, people usually sell that property, like what LJ had done, before coming back, because that's usually the cleanest way to do things. Yeah. So yeah, maybe a little bit more on that question, right? So the other point to mention is, if you have let's use smaller numbers. If you had a 500K mortgage in the UK, that just means you'll be able to borrow 500K less in Australia. So if you wanted that big dream home in Australia that cost you $1 million or $2 million, you would be restricted by the existing mortgage you had in the UK, right? So they will check, and yeah, it just really depends on your situation. If you wanted to keep the UK investment property because you think the UK has a lot of capital appreciation potential, then yeah, you would keep the UK mortgage. That just means that your purchase in Australia will be a bit smaller. Yeah. So I hope that answers that question. Now, next topic, and I think this is the one that the majority of the questions were about, which is, do we want to buy now or do we want to buy when we get back? So there are a few key considerations. I can't help with all of them, but I think these are the things you should be thinking about before you repatriate back to Australia. The first one is probably personal employment and schooling. So where are the kids going to go to school? Do you have a job lined up in Australia? What's the partner going to do if you have a partner when you go back? These visas, things like that, we don't help with that, but those are definitely things you should consider. The second piece is the property, the mortgage. Those are the things that we can help with: where you want to live, how to get a mortgage, how do you maximize your borrowing if you want to do that. Now, I keep saying maximize borrowing in this webinar, but do keep in mind that it's not always the best idea to maximize your borrowing if you can't make the repayments when you get back to Australia. But we can definitely show you how to do it if you wanted to do that. The last point is probably finances. So planning your taxes, how to repatriate, other financial considerations. So third one is financial planners. Second one is property buyers, buyer's agents, mortgage brokers. And then the first one is kind of on yourself to figure out. So the common question, looking to move back in the next 6 to 18 months, is it better to buy a property now or when we get back? Well, as with all things in life, there are pros and cons. So the pros, you're able to maximize your borrowing for a dream home. This is assuming you have stronger income. And also, another benefit is if you were in a low tax environment, which really boosts your take-home income. The mortgage application is more efficient. and there are reduced relocation logistics and headaches. I'll talk about all of these in detail in the next few slides. The cons are you will have reduced income and higher repayments when you get back to Australia. So what happens afterwards? If you max out your borrowing, get that dream home, and then you move back and your income significantly reduced, what happens then? Second con, you cannot immediately claim grants. You need to commit to buying before settling down in Australia. And yeah, I'll go through all of these in details. This is just a summary page. Yeah. Okay, so buying as an expat, what are the pros? So expats are able to maximize borrowing for a dream home. The expat usually has higher borrowing power. So I'm not sure where everyone's based, but a lot of the people working in the financial industry in New York, London, Hong Kong, Singapore, they generally get paid slightly more than their Australian counterparts because of just the more regional nature of those cities. You will have 2 years of bonus usually. So the banks will consider that bonus income when they assess your application. You have a lower tax rate, so 10 to 20% effective if you're in Singapore and Hong Kong, and no tax for the guys and girls in Dubai. And you can claim your rental income, your investment property rental income. So you buy it and you tell the bank that, hey, I'm going to rent it out $540 a week, and you can use that in your stress test. Whereas if you're only going to borrow when you get back to Australia, your borrowing power is probably not as strong. Your income is going to be slightly lower in Australia. You're going to be on a higher tax rate, 30 to 45% effective tax rate. And like LJ was saying earlier, you now need to consider things like your HEX loan. You need to consider things like Medicare levy. You need to consider 10% superannuation. All these things play into how much the bank will lend to you. So while you're an expat, it's usually quite clean how much money you're getting, assuming you're not just blowing it all in Soho. Next slide. So this one's, I'll just briefly skim over this one because it's a bit text heavy. The mortgage application will be more efficient because banks like stability. If you're moving here and there, moving from New York to London, back to Australia, the banks are like, this person looks like he's constantly changing jobs. I want to wait it out. I want to see 3 months of pay slips. I want to see that they pass their probation before I lend to them. When you're in a new job, you'll also not be able to use your bonus income. So I know I'm generalizing here, but for the lawyers and the bankers, or those kind of usual expats, they have a bonus that's paid every year or 2 years. So if you move back to Australia, you can't show that you have bonus for the past 2 years because you're in a new role. So you would then again not be able to borrow as much, then HEX, etc. The upside if you go back to Australia is you can get an owner-occupier loan, which is generally a little bit cheaper. But while you're an expat, you have to get an investment loan, which then becomes an owner-occupier loan, which I'll give a few examples later as well. So buying as an expat, reduce relocation logistics. How long do you want to be in accommodation limbo for, right? Do you want to move once into your home, or do you want to move twice into a hotel, into an Airbnb, or with your parents? What did you do, LJ, when you first moved back to Australia and you hadn't found that property yet? Where were you guys living?
Oh my goodness! First of all, we had 6 weeks in a service department. Then our dog arrived from Hong Kong, so then we had 6 weeks in a Airbnb, and then we moved into a rental, which we thought we were in until we would buy, and then the landlord decided to sell that. So 12 months later, we packed up everything all over again and moved out, and then into another rental, and then 6 months later, we finally found our home. And we were very lucky. We used a buyer's agent, so it was easier. But the moving, don't be surprised about the moving. I was ready to tear my hair out. It was so hard. If I could have bought before we moved back, absolutely, hands down, I would have done it.
Yeah, sounds like a nightmare.
It was a nightmare.
Yeah. And then related to that is how long do you want to be in this limbo for, right? So for example, if your kids then need to go to school, you're also placing your kids' kind of well-being, putting that into that picture as well. Like, do they want to be traveling to school, learning 3 to 4 different new routes to get to school, catching a different bus every time you move? So that's another consideration. If you change your mind on your job, so let's say you moved back to Australia, you took on a job, you hated your colleagues, hated your boss, and you wanted to change again, then you would need another 3 months of pay slips, right? So it's really delaying the whole process if you wait until you go back to Australia. Obviously, there's cons, which I will talk about as well, but these are just the pros. And then I guess one thing you should also consider is, are you comfortable? This is kind of a flip side. Are you comfortable buying when you're overseas, right? So a lot of people will say, hey, I'm not in Australia, can't see the property. Do I trust it? Do I buy it without seeing it? So yeah, this one is definitely something for you to consider yourself. But like LJ said, you can use a buyer's agent, leverage on your parents, on your relatives to find you a property. And with all the technology these days, you can actually do a live Zoom kind of walkthrough with the agent to look at the property like that as well. And I also see a lot of videos of properties these days. So I think it's relatively safe to buy while you're overseas and haven't seen the property. Just obviously do your due diligence.
Using a buyer's agent was incredible. Like, for anybody that is overseas and isn't sure about it, having gone on site many times with a buyer's agent while we were searching, it was incredible, because I would see something and I'd say, oh my God, I love this house. I fall in love with it. And she would literally pull me back and say, well, hang on, did you see the mold down there in that corner? And it's south facing, and it might feel nice and cool now, but it's going to freeze in winter. You're going to have damp. So she actually saved us a lot more money than she cost us, a lot more money. So yeah, I wouldn't have used one from overseas before I came back, but now I'm a huge fan of it. Absolutely. Just the right one. You have to find the right agent.
Yep. And obviously, because we've been in this industry so long, we have a good list of buyer's agents that we can also introduce you to. So reach out if you want an introduction. So the first con, reduced income after repatriation and higher repayments. Yes, you can borrow more, but the question is, should you borrow more? Right? I'm definitely not an advocate of borrowing and living beyond your means, because this comes back to bite you, right? You can have reduced income upon repatriation. Can you afford these repayments? That's a critical question that you need to answer. And we can help you workshop and determine what are your repayments going to be, what's your income going to be when you go back to Australia, to make sure this works for you. And yeah, again, use our calculator. It's on our website, plug in the numbers. It takes 20 seconds to key in the numbers, and then you can kind of see what the monthly repayments will be. You cannot immediately claim grants. So for example, stamp duty rebates, these are only applicable after before certain thresholds, usually less relevant for anything above 600 or 700K. And usually you need to be in Australia. So unfortunately, when you're an expat, you can't get these, but you can get them when you go back to Australia and you buy another property, or you want to sign an application for a first-time owner's grant that you use somewhere else. These are not foregone when you get back to Australia. And you can check out the website there for more details. The key takeaways is just generally not relevant for expats and more expensive purchases. Final con, buying as an expat while, well, you need to commit before settling down in Australia. So you run the risk of buying something you have not physically seen, which is what we discussed earlier with LJ. What are the mitigants? Well, start the process early and do not FOMO in. Buy in areas you're familiar with and understand. Leverage on friends and family. Utilize buyer's agents to do due diligence. And yeah, the last point is leverage on buyer's agents to do due diligence. We'll go into a case study. So family of 4, they secured a role in Perth and they wanted to buy before they repatriated. So LJ, I didn't include names like you suggested here, because actually these are real clients, and I'm not sure the clients would want their names to be plastered all over the internet. So I didn't include it for this particular example. So before repatriation, while they're still an expat, we got them pre-approved for a $1.5 million purchase at about 3%, investment property, and an expat-friendly bank. 1 month later, they utilized the buyer's agents to find their dream home. So what was their definition of a dream home? They wanted 4 bedrooms because they had 2 kids. They wanted to be near the beach. They wanted to have a swimming pool, and they wanted to be near their selected primary school. So the buyer's agent helped them find that. 6 months later, they moved back to Australia, and we helped them swap to an owner-occupier mortgage. Once they landed, they just had to update a few details, and then we can help them process that. And the rate you'll see came down by about 40 basis points. So that's one example if you want to buy before repatriating. The second example is someone who wanted to buy before repatriating again, but only for the kids and the wife to move back first. And I guess this was a COVID consideration because this happened just recently. So we got them a pre-approval for $2 million at an expat-friendly bank. They didn't use a buyer's agent because they had the expertise to look for their own property. So they found a property independently, the dream home for the wife and the kids. And then they went through a half repatriation process, which was where the kids and the wife moved back first. We were able to switch the mortgage to an owner-occupier while the husband remained in Hong Kong. So yeah, I'll wrap up here. Last 4 tips before we move into the Q&A. So tip number 1, use an expat mortgage broker if you are based overseas. Get a pre-approval to avoid any headaches. Leverage on your expat status and earning power to consider getting ahead of the hikes. And finally, review your existing mortgages and properties for cost savings or cash out potential. So that wraps up my session, and I'll probably pass over to LJ now to go through some Q&A. So if you have any questions, leave them in the chat and I'll try and answer those. So I'll pass it over to you, LJ.
Great. Thanks, Martin. You should probably have a little sip of water.
Definitely
You
need
did
it.
so well. That's amazing. Really, really interesting. Some really interesting points in there. There was a question that came in, which was from Jeremy in Hong Kong, which was, can we use income from a share portfolio? I think that means in relation to an application mortgage.
Yep. So it depends, as with all expat mortgages, it depends on the bank. Some banks will allow you to use it, but they want to see consistent dividends, right? So if you're in the US, right, and dividends are paid quarterly, maybe they like that. But if dividends on your particular stock are paid once every 1 year, and then they stop for 2 years, and then they pay it every 4 years, they don't like that. They won't annualize that for you. But if you're holding an ETF and it pays very regularly every quarter, then sometimes you can use that. But really, it depends on the bank. Not all banks will accept it.
Okay. Angie has asked if there are age limits related to sourcing property finance to consider.
Yep, so there's definitely age limits. Depending on the bank, again, so some banks are very relaxed as long as you can show a clear exit strategy or a mitigant to you about to retire, then they will lend you money even if you're close to retirement. So for example, if you're 50 or 60 years old and you're retiring in 10, 20 years, some banks will say, well, once you retire, you won't have any income, therefore I'm only going to lend you for 10, 20 years. But some banks like ANZ have a clear exit strategy, whether that's for selling property, then they will lend you 30 years. Yeah.
Okay. Now, Penny, who is over in Finland, she says that as current renters, less than 20% deposit, moderate income, first home buyer in Australia, it's sounding like we should wait to return. Should they, wait until they return? And she's also said there, should we still contact Odin? These guys specifically are designed to work for people who are still overseas. So that's their area of speciality. So Martin can go a little bit more into that. But first of all, should she wait until she comes home?
Yeah, so I guess if you do decide to do it overseas, we're definitely the right ones for you. But if you go back to Australia, we can still help, but I think you just have a nicer experience with a broker on the ground that can meet you in person and hold your hand while you go through the process. So that's the difference. But I guess to answer your question of should you wait, well, really it comes back to the slides I mentioned before, right? So if you wait and go back to Australia and you have lower income, potentially you wouldn't be able to buy something as nice or as big as if you had the stronger income, assuming you had stronger income while you're overseas. When you're back in Australia, you can tap into LMI products, which allow you to borrow up to 95% while you're in Australia, which would be better than the 80% options that are generally only available to expats. So how about you come speak to us and we will then go over your situation and we'll give you our recommendation, right? So it's a bit hard to give you a recommendation exactly on what you should do over this webinar, but that's why we're here. We give free assessments, so come speak to us and I'll sort you out.
Okay, great. Now, Penny says thanks. So we have had a lot of people still asking questions about their properties overseas. So I just want to clarify that. So if they do have property overseas, it's a little messy to include that as part of their mortgage application, as in terms of the collateral that's sitting there. They should either deal with that separately in the country of that they've got their property located, and get refinancing there, get the equity out, and then move that to Australia. That's what you were saying?
Yep, so you're clearly listening very intensely.
I'm an active listener.
Yep. So that's spot on. That's spot on. So if you want to keep the UK mortgage and you want to release equity from the UK mortgage because you think it's a great investment or because you just bought it, you should definitely speak to a UK bank or a UK mortgage broker to do the first leg of that transaction to get cash. Once you get the cash, then we can help you as an Australian mortgage broker with the Australian side of things. Now, yep.
Well, sorry, I was just going to say, so really, if you tell the banks in Australia that you've got property overseas, it does just muddy the water, as you said. It just makes them more concerned about, well, how much are you spending over there? And they'd be concerned. So are you better just not mentioning it?
So you definitely have to mention it. You have to mention it. Yeah. So you have to mention all your liabilities. So yeah, LJ, you're correct. It actually makes things a bit messier for your Australian application. Think of your borrowing power like a jug of water. If you pour 50% of that out in the UK, you have 50% less to use in Australia, right? If your total borrowing power based on your income is $1 million, right? And you spent 500K of that in the UK, when you get back to Australia, you'll only be able to use the remaining 500K to buy a property. So is that 500K enough for you in Australia? It could be. Or you want that dream home that I keep referring to, which is $1 million, then you would be disadvantaged by holding a UK property. The other disadvantage is the Australian banks, because they have no oversight of what's happening in the UK, they'll actually apply a haircut on everything in the UK. So a haircut in a bad sense, right? If you're renting it out for $400 a week in the UK, they'll look at it and say, it's a bit risky. I'm only going to assume that you get $300 of that per week. So it muddies the waters, and also it puts you in a disadvantage relative to your Australian mortgage. But hey, who knows? The UK could be a great investment. Then net you come out ahead. But just from a pure Australian perspective, yeah, you would definitely want to get rid of that.
Okay, perfect. We've had a few more questions.
What LJ did. What LJ did.
Yeah. So we've got a few more questions. One is, can you get mortgages in foreign currencies or only in Aussie dollars?
Yeah, so you used to be able to get mortgages in foreign currency, but banks really scaled back on that. So it's actually extremely hard to do that. We do have some partners in Hong Kong and Singapore where you can borrow in Singaporean dollars or Hong Kong dollars. But unfortunately, we do not have any partners in US or UK or wherever you are based for a mortgage in foreign currency. But So usually when people ask us this question, it's probably because they need to make mortgage repayments. But what you got to remember is if you buy an investment property while you're overseas and you rent this out, the rental income, which is in Australian dollars, is going to be able to help you cover your mortgage. So you really do not need to repay your mortgage in a foreign currency because your tenant is going to help you repay some of that. So maybe you have to top up $50 every month, but you just do a lump sum transfer over to Australia, and that will cover you, unless you're worried about FX changes and all that kind of stuff, which there are obviously ways to get around that.
Okay. So we've had another question about overseas funds. So are overseas pension savings relevant at all? Should they be mentioned?
If you say savings, the banks usually don't consider how much cash you have. If it's a pension income, some banks will allow that, right? Some banks will take that and let you use it. So again, this is what I said at the very start of my slide. Every bank has a different policy. So you could go to ANZ, CBA, Westpac, NAB, and they all say no, and you assume the answer is no. But really, there could be a bank sitting in Queensland or in Western Australia that actually does take pension income. Then we could take you there and you could use that pension income to borrow.
Okay. Another question has just come in on the chat. Before I ask this one from Kieran, can I just ask, so how many banks and like financial institutions do you work with or can you work with?
Yeah, so we work with over 45 financial institutions,
okay.
based both domestically and overseas. So we are licensed to work with all of these, but generally speaking for expats, only a handful are relevant and useful. So probably only 5 to 10. Now these 5 to 10 are usually not the big four. So if you go direct to the big four, you're probably not going to have the best experience. A lot of our clients that we service, they come to us and say, thank you guys so much because we went to CBA 6 months ago and they just took us through a walk and they just couldn't get any of the things that they wanted at the big four.
Okay, so I've just seen a few more questions. I'm going to go to, actually Tim's is a quick and easy one. So Tim has asked what if one's overseas properties were mortgage free? Does that change the situation?
Yeah, so that's a great position to be in, but it's still a disadvantage. It doesn't muddy the waters, but it's a disadvantage because not all banks will take foreign rental income. So again, if you went to the wrong bank, let's say, for example, the big four again, we say, hey, you went to the big four, they looked at foreign income and they're like, we don't have appetite for foreign rental income. We won't use that income. Whereas if you go to a bank that's friendly towards expats, they will say, yeah, sure, we'll take your foreign income. However, we'll apply a 20% discount on that property, right? So it's useful, definitely helps, but still a slight disadvantage because if that property was in Australia and you're getting $500 a week, the Australian banks will say, sure, Australian dollar income, we 100% understand that. Let's take 100% of it. Let's use the full $500. If that same property was in the UK, they would say, not sure about the UK, let's just use $400. So you're slightly disadvantaged.
Okay. We've just got 2 more questions. Have you got it in you to do 2 more questions?
Yeah, of course.
Tim, apologies. I left your question until the end there. I didn't see the little Q&A button. So the question coming from Kieran Rogers is, what would your recommendation then be if one has available disposable income to pay a greater amount upfront versus taking advantage of the higher borrowing opportunity with being an expat? And he's saying that's just simply because of the hiking rates at the moment, which is regardless of being expat or local.
Sorry, LJ, can you repeat the first part of that question? You cut out for a bit.
What would your recommendation then be if one has a available disposable income to pay a greater amount upfront versus taking advantage of the higher borrowing opportunity with being an expat?
Yeah. So what I would say to that is there's 2 angles to go about that, right? The first angle is you can leverage on what's called an offset account, right? So you take out the maximum loan that you can get, and then you put all this excess cash and savings that you have inside the offset account, which offsets the interest rate, which means you have to pay less interest rate on your mortgage, right? So that's perfect on a variable loan. So let's say you took out a $1 million mortgage, but you actually had $1 million in cash. You put that $1 million in the offset account, and essentially you have no interest on this property, right? So any excess savings you have, you're very open to just put it in the offset account. Now, why you would do something like this is because you want flexibility. Say you needed that cash for a rainy day, a holiday, or other investments. You can then quickly tap into these savings in your offset account to then do anything else that you want to do. Whereas if you took a low mortgage and you really used your own cash, that's completely locked up in your property. You cannot access that unless you refinance or unless you change banks and you want to top up again. So it's definitely a lot more painful. And our recommendation is always to take out a higher loan with an offset account if you have excess cash, because then you can put that excess cash back in the offset account. It's actually the same thing, but more flexibility for you.
Okay. One more question, and then we should really let people go and finish their lunch. Katrina asks, what are the considerations when one partner is Australian and the other isn't? Does it affect it?
Yeah, so that's a very common situation. So if your partner is a foreigner, so let's say a Brit or a US citizen, then it's actually quite hard for them to get lending. If your income alone is strong enough to service the loan, then you can actually borrow just in your own name. But sometimes a partner is unemployed and they do not have a job, then you probably need to bring on the foreigner, the UK citizen or the US citizen or wherever you're based, onto the mortgage as well. But the downside of that is if you're a foreigner, the rates are actually a little bit more expensive because you're not an Aussie citizen, so you don't get all the benefits that the Aussies do. So if you're a foreigner, you're going to pay a little bit more. And you can still buy the property in just the Australian citizen's name, which means that the taxes and the stamp duty that you have to pay can be reduced, but just have the partner that's not an Aussie on the mortgage to help service the loan. I hope that helps.
Yeah.
So,
okay.
So I don't know if the same person that asked that question had a follow-up, even if the foreigner in the relationship is a permanent resident. So yeah, if you're a permanent resident, then the situation changes again slightly, right? So again, depends on the bank and your status. So come speak to us and we can really assess your situation before we give a holistic kind of assessment.
Okay. Look, I think that's probably what we've got time for today. I do have another question, but I'm sure I'll get to ask it another time. I just wanted to let everybody know that there were questions that came through on the registration forms about tax and property, and Martin and the team are not tax specialists. They specialize in mortgages. So even though Martin said, look, he can give you a top line information around that, we wouldn't want to give you the information that isn't coming from that specialist. So we hope you understand, and there will be a tax webinar coming soon as well. So stay tuned for that. And look, we do have a lot more questions, but I think that's probably been an amazing hour. And Martin, this is the first webinar about mortgages and money that I haven't been bored to tears in. So thank you very much. They're normally so boring. I hope everybody else has felt the same way. And thank you all for joining us. And a really huge thanks to Martin and your team as well. Do you have anything else you want to say before we go?
No, I think maybe LJ, you can talk a little bit more about all the other wonderful things you're doing with your groups and potential webinars coming up. Nothing to add on my side.
Look, there's a lot of exciting things coming up, so watch this space. For everybody who is here who isn't a member of Aussie Expats Coming Home, please join Aussie Expats Coming Home. We have a Facebook public page where you can see any updates, any events that I publish, but our group is a private group. We've now got 12,000 incredibly fabulous people. We very rarely have a drama in that group. And it was started by me in 2018 after, like I said, 20 years away. It's pretty hard to figure out how to get a Medicare card and a driver's license. And none of my friends that had never left Australia knew how to do it. So we've gone from just asking a few friends a few questions to literally bringing home thousands during the pandemic, which we feel really, really good about. And you know, I think the thing is, it's by expats for expats. Everybody who's in the group is either coming back or come back. And you know, moving home is a lot harder than you think. It's not, doesn't end once you touch the ground. So we run a lot of free events as well around Australia that are volunteer led. So you can come and have coffee with us, come and have drinks with us, come for a walk with the dog with us. And I'm all about helping Aussies move home in any way, shape or form. So come join the group and follow us on Insta as well. I'm trying to make that look fabulous. And that's it really. Thank you so much. And thank you so much for being our very first webinar of our webinar series.
Awesome. Yeah, thanks so much, LJ.
And thanks everybody for joining us as well around the world.
Yeah. Okay, cool. I'll probably end the webinar now then.
Terrific. And everybody, there is, hang on, there is a recording. So if you do need to go over this again and just marvel at how fabulous Martin looks, he will send you all a recording out and yeah, share it with your friends.
All right.
Great.
Thanks, LJ.
And thank you for joining us.
Bye.
Okay. Bye.